I just wanted to start here with the South African medium-term budget that we got this week. Significant headlines that came from it. Probably the biggest, though, was a massive jump in borrowing and also raising taxes here in South Africa. I mean, can you just give us your perspective? How concerned are you about the South African economy, considering what we heard from the finance minister?
Jennifer, thank you very much. Great question. But let me start with how the capital markets and the money markets will respond to this. Firstly, the rand has strengthened. As at 2 o'clock South African time, it had strengthened. The bond yields have narrowed, and the JSE All Share Index was up by 0.7%. So the markets have responded well. Secondly, I would submit to you that all the rating agencies will keep their neutral outlook for South Africa. And the main reason for that is because the budget speech is consistent with assumptions that most people would have made around the debt to GDP ratio. At 77.7%, it's about where everybody who had projected would have found the right levels. Clearly, the deficit widening by 0.8% is a concern, but there's no big worry that South Africa will have difficulty in meeting its obligations as they fall due. What did come through is proper fiscal discipline. There's going to be a cutback in spending. I think the expenditure on the expenses on staff are well managed. Collections, I think there's been a shortfall, but that's as a consequence of the difficult economic environment. Let me just add, though, that the debt to GDP ratio in South Africa is clearly sensitive to the growth in the economy, and the National Treasury assumed growth of 0.8% this year and 1% next year, subject, of course, to structural reforms which, if executed with discipline, could then increase the country's growth rate, which then improves the debt to GDP ratio.
That is really the concern, though, right? That the reforms are not going to happen fast enough. What, in your opinion, needs to happen in the next few months, especially before the election next year, to really give investors the confidence that this government is heading in the right trajectory?
I think acceleration in addressing the energy situation in the country, continued restructuring of Eskom, fixing its balance sheet, improving its transmission capability, and continuing to improve the electricity situation. Secondly, same logic in respect of logistics, improving the position at Transnet, dealing with the fact that Transnet needs 100 billion rand injection, which is not included in the current projections, dealing with the structural reforms associated with Transnet. Thirdly, dealing with crime. All three of these vectors are in close cooperation with the South African business community. But there's also other structural reforms that need to be accelerated. For example, in respect of the spectrum, in respect of the water sector, and importantly, as I said, just to go back to the crime situation, dealing with crime and corruption.
And Sim, we should note that you're in New York as part of the South Africa investment conference opportunity. When you're talking to investors there, considering the flurry of headwinds sort of ahead for this country, what makes it an attractive investment compared to other countries such as Indonesia or India? I mean, why would investors want to park their money here?
First of all, because of the strength of South African institutions. My favorite institutions, of course, are the central bank. The central bank governor has got an A- rating. He's one of the top 20 central governors in the world. Secondly, the National Treasury. In terms of budget transparency, it's ranked second in the world after Georgia, and it ranks ahead of New Zealand. So the country's institutions are well managed. Secondly, there's a clear understanding of the size of the formal economy versus the informal economy. And as far as this goes, the increased ability of the South African Revenue Authority, their ability to collect taxes, continues to improve. And you saw it in the numbers that have been released and in the policy changes and the capability of that institution to collect. Thirdly, the rule of law. Everybody understands that you will meet your obligations as they fall due because of the strength of the rule of law. Fourthly, the business sector is well organized, it's highly regarded, and it's innovative. And fifthly, South Africa is part of a great neighborhood. The African continent is going to be the fastest growing part of the world after 2030. Africans are getting healthier, wealthier, with greater disposable income, and there's greater infrastructure that is going to be rolled out. And if you want to share in that growth, you've got to be in South Africa.
I also want to talk about growth because I know in the same discussions that we've had about growth, there's also the discussions about sovereign debt. And I know you yourself have sort of talked about the concerns around countries like Malawi and Ghana and Kenya. I mean, when it comes to addressing the debt distress issues that a lot of these countries are facing, what do you think the right vehicle is for this? Is the IMF Common Framework the right approach, or what do we need to maybe look at going forward?
I think, Jennifer, at the end of the day, the old-fashioned orthodoxy is what needs to be done. Following fiscal discipline, clarity on the role of the fiscus relative to the monetary authorities, clear articulation of industrial policies, opening up those economies, making sure that privatization happens, sticking to fiscal discipline, and all the traditional approaches that one would have spoken about. And then if you look at the countries that you made mention of, each of them have had to focus on these structural reforms in order to be able to get assistance from the IMF. In addition to that, of course, there's a need to make sure that bilateral lenders are dealt with appropriately, whether it be the Paris Club or the Chinese lenders.
Where is Standard Bank focusing on growth? There had been a lot of concentration in East Africa. I mean, are you seeing other opportunities elsewhere? Are you potentially looking at other markets to expand, considering the growth pockets that you're paying attention to?
Jennifer, the fastest growing parts of the Standard Bank Group are all those operations outside South Africa. And as you know, the operations outside South Africa now make up half of the banking revenues and banking profits of the Standard Bank Group. We see growth opportunities throughout the African continent, but the East Africa region is particularly attractive because of the increased integration in the East Africa community. That community is built to grow to, at close to $1 trillion in the next few years. The population's built to be over 500 million people. There's greater integration. There's more movement of goods, people, ideas, and capital between those countries. And as a result, throughout the last 20 years, they've grown at about 5%. And there's no reason to believe why they will not continue to grow at those levels. And therefore, that's a region that you want to be part of. But the general proposition in respect of East Africa applies equally throughout the African continent.
What does that mean for expansion for the bank then?
It means we will follow our clients, we will provide them with the products and services that they need, we will continue to grow organically as we always have, and when inorganic opportunities present themselves, we will look at them carefully.
Do you still see, considering what you said, do you still see South Africa then as integral to the bank's success, or do you focus more then outside of this country?
Jennifer, South Africa will continue to be a large proportion of the group. The South African economy is massive, the third largest economy on the African continent. And if it grows, if it starts growing at 3%, for example, because of the large base and the large scale, the impact thereof would be tremendous. And so we want to retain our dominant position in South Africa in the various product sets and customer segments where we are dominant: foreign exchange, trade, global markets, transactional products, home loans, vehicle and asset finance. Want to retain and protect that competitive position.
And Sim, just finally, because you mentioned foreign exchange, I have to go here. I mean, we've seen a stronger dollar. You're in the U.S. right now. The stronger dollar has really resulted in, for the most part, weakening currencies across this continent. I mean, what is your projection for a number of African currencies? Because this is, of course, hurting any sort of development or growth that we're seeing in any of these economies. So what is your projection over the next few months?
Jennifer, at the high level, we at Standard Bank believe that there will be a soft landing, so let's just make that point. But we also believe that interest rates will remain higher for longer. One of the consequences of that, of course, is that productivity on the African continent needs to increase so that we can attract investment on the African continent. And those of us who are very careful about the way we've allocated resources will benefit from that.
What's your expectation then? I mean, because the countries that I just mentioned, and I didn't even get to mention Nigeria, of course, and the issues around the Naira, when do you expect to start benefiting, to start recovering from this current situation that we're in right now?
Jennifer, we've already seen the benefits thereof. Orthodox policies where you have a reduction in the difference between the official rate and the parallel rate, introducing discipline in that space, making sure that there's also discipline in monetary policy is definitely good for the economy. Clearly introducing programs that reduce subsidies has got a materially negative impact on society. It increases inflation, but over time, those policies, if the authorities stick to them, give rise to better economic performance and therefore an interest by foreign investors to come back into the market. And so it's a matter of time before people start going back, for as long as the authorities stick to the orthodoxy.
Yeah, and that's a lot of the concern there. Sim, just finally, I know I've gone a little bit over with you, but I also wanted to talk to you about China because this is, of course, a part of the global economic story. The recovery there in China has been weaker than anticipated. For Standard Bank, I mean, do you potentially see opportunity in the current moment that we're in, or do you reduce your exposure to China given the sluggish results that we've been seeing over the past few months?
You know, Jennifer, banking is a derived industry. We see continued opportunities from Chinese investors looking for opportunities to invest in either infrastructure or purchasing assets on the African continent. And at the same time, we're seeing greater opportunity from activity arising from the clients who are based in the European Union, as well as clients based in the United States. And it's a wonderful opportunity for Africa where, you know, you've got a larger population, you've got people investing in infrastructure. We're going to need $3.4 trillion in infrastructure investment on the African continent, and we will take it from whence it comes, including, might I just add, South Korea. And so it's a wonderful time for Africans as Africans get younger and healthier on the retail side and as they invest in roads, ports, and infrastructure on the corporate and investment banking side. So it's an exciting time to be in banking on the continent.